And good morning. This will be my call to order for the St. Mary's County Government Length of Service Awards Program Committee meeting Thursday, July 22nd at 9:30 a.m. in the Chesapeake Building, 41770 Baldridge Street, Leonardtown, Maryland. And the first thing I'll do is have a roll call starting to my left with Commissioner Hewitt.
Here.
Here. Jeanette.
David Weiskopf.
Oh,
Catherine Prattson, here.
I should have said Mike Hewitt. I'm here.
Jeanette Cudmore.
Thanks, guys. Didn't mean to put you on the spot. And
That's
then,
all right. We've got paying attention.
right, and next is the approval of the July 22nd agenda.
I'll make a motion to approve the agenda for July 22nd.
And I'll second.
Thank all those in favor?
Aye.
Aye. Motion carries. Next is the approval of the June 4th, 2021 meeting minutes.
I'll wait for everybody else, but I've read these, and I'm going to make a motion to approve them. If we need a minute to do a second, that's fine.
Yeah, I read them as well, so I'll second.
Okay, we have a first and a second. All those in favor?
Aye.
Aye. Ayes have it. Motion carries. Moving right along, we have Mr. Wing from Marquette Associates here to do his presentation.
All right, great. Well, good morning, everyone. and Good morning, Jody, as well.
Good morning.
So we have a fairly light agenda today. As you look to the agenda there on the document, we have a recommendation for the committee's consideration, just given we've seen a buildup in cash over the last month and a half since we met, so put some of that to work. And then the majority of our discussion today will be related to the investment policy statement, really the culmination of all the work and meetings and education over the past 6 months. So at our last meeting, we walked through the asset allocation study. The committee determined how they wanted to proceed. And now it's just a exercise of putting together the new document. So what we have here for the committee to review is the old document, just highlighting some things where we feel there are changes to be made, and then a draft of the new document. So I'll walk through things at a very high level, and then we'll talk about how to proceed when we wrap up through the next steps there. But with all that said, if you have the hard copy book in front of you, if you could flip behind Exhibit 1, where you see the cover page there says recommendations, and then behind that, on page 4, as we typically do, we'll show the fund allocation. So a couple quick comments before we get into the recommendation itself. You see the total assets of the trust in that third column up at the top was $6.23 million. That is as of about a week ago. That's a gain of about $115,000 since we last met in early June. We've seen equity markets continue to do reasonably well. We've also seen some stabilization in interest rates. So when fixed income really took it on the chin in the first quarter, when rates rose quite dramatically, we've seen some stabilization there. So fixed income has performed a little bit better of late. And putting those pieces together, again, we've seen that gain of about $115,000 over the past month and a half or so. So the last item I want to draw to your attention before we get into the specifics here is that bottom left-hand table on page 4. So as you recall, you see the black rows to the left there listing all the asset classes. Those are the current asset classes per the current policy. And as you work your way from left to right, the black are the current allocations, the blue are the targets, and then the difference is green and red. So green meaning an asset class is an overweight relative to that target, and vice versa for red. So as you work your way up and down that table there, again, the bottom left one under the differences, you can see there's somewhat of an overweight to equities. We continue to think that makes sense given the environment, the economic reopening, strong corporate earnings. And where you see somewhat of an underweight is within investment grade fixed income. So that's very safe core fixed income where interest rates remain very, very low, sort of in this 1.5% range. And like we talked about, those rates are going to drive returns moving forward. Just like when you go to a bank and buy a CD, that initial rate is really the determinant of the return on that investment moving forward. And those interest rates remain extremely low. So with that context, if you look at the table, the larger table up top, towards the bottom where you see cash, all the way to the left there towards the bottom, you see cash and equivalents, and then the Schwab Bank Suite. That's the money market fund within the LoSAP. And as you work your way from left to right, you can see that number's almost $51,000. So that's where the number was the last time we met. There was a rebalancing to put that money to work, but what happens towards quarter end is a lot of the ETFs pay dividends. So they paid dividends in between our last two meetings. So that number was 50, we drew it down closer to 20, and now it's built back up to 50 since the last time we met. So in the middle of the page there in the rebalancing, again, towards the bottom, what we were recommending, if you focus again on that cash line, is drawing down that cash. We simply don't need it. There aren't any cash flows. The fees and expenses are de minimis. So taking about $30,000 of that and moving it into within fixed income, the iShares Broad USD High Yield Corporate Bond ETF. So that is a fixed income investment that's a little bit more aggressive than, say, a core safer approach, but the yield is a higher, sort of in the 4 to 4.5% range. So we're talking about moving money back into fixed income, but into an opportunity that we expect to pay a little bit of a higher return, certainly in the near term and certainly in the long term. So that recommendation is summarized on page 5. We recommend the committee approve that rebalancing as shown on the previous page and is summarized below. Again, adding $30,000 to that high yield bond ETF and sourcing that money from cash. So with all that said, please pause for a quick second to address any comments or questions from the committee.
I agree with putting cash to work. I make a motion to move $30,000 from the Schwab, what's that called? Bank sweep cash to iShares Broad USD High Yield Corporate Bond ETF.
And I'll second.
Okay, I have a motion with a first and a second. All in favor?
Aye.
Any opposed? No. Ayes have it, motion carries.
And while we're here, we're getting ready to move another 3.2 million into this fund.
Okay.
So you should be seeing that sometime in the near future.
Yes.
And my point to you is that don't lose it.
I'm sorry, what?
Don't lose it.
No.
Just kidding, you know what I'm saying.
Absolutely. Now,
We are going to be, the commissioners did decide to go in this route, and so you'll be seeing that money.
okay. And just a quick follow-up to process related to that question. Now, we're not scheduled to meet again until the latter half of August, maybe 5 weeks' time. Is it something where the money will sit in cash and then we'll come back with a
Well,
recommendation?
that's probably a good question. What's your thoughts?
I'm thinking we'll go ahead and try to send it to you prior to the end of July. And then maybe you can come back, I think, at the end of August.
Right.
Or beforehand, if you want
Well, I'd
to
like
make a
it,
recommendation on where to move it to.
I'd like it something higher than cash, but
Right.
what's your thoughts?
Oh, I would assume that you would just put it in these, in our portfolio,
Right.
Allocated accordingly?
allocated as the percentages, right?
Correct. And
Like if
can-
we
and-
gave, if we were to give you $1 million, 30% would go U.S. equities and so on. In that way.
Exactly, and we can do just that. I just want
That-
to make sure we're not overstepping
Yeah, no.
exactly what we're.
Move it to where the percentages
Right,
are, based
right,
on our target
Cover
policy.
cover yourself here, yes, I agree.
Yeah.
Right.
So,
What do you
just
think?
ask from.
I think that's fine, and then,
As long as you think that's appropriate. I
Oh,
mean,
sure, absolutely. That
and
I-
you can provide an update when we have our August meeting.
absolutely.
Right, and if we need to rebalance again.
We can
would
do
be-
that
Care.
at that time.
Perfect. So, if, Ms. Cudmore, if you could just let us know on the timing, so it's not sitting in cash.
Right.
And then as soon as it comes in, then we'll implemented based on the allocations and then report back to the committee and have any subsequent recommendations
Sure.
at that time too.
What's your thoughts, Catherine?
I think that makes sense. I'm just wondering if we need a motion.
No, that probably best interest.
Make
Yeah.
Mr. Wing happy, I think.
Yeah.
I move that the $3.2 million allocation that will be coming forth before the end of July will be allocated to the individual accounts as listed,
And I'll
Yeah,
second.
in accordance with the policy statement.
in accordance
Yeah.
with the policy statement, yeah.
And I'll
that's a better-
second.
Could we have a first and second? All in favor?
Aye.
Ayes have it, motion carries.
And I'll
Perfect.
work with Jody to have those wires transferred to
All
you.
right, perfect. Thank you.
Thank you.
Okay, so with all that said, we are ready to move into the next item on the agenda for
Certainly.
the investment policy statement review. So if you flip behind the next exhibit to page 7 here, just wanted to take a minute here as a broad overview of our beliefs and thoughts on best practices from a policy statement perspective. What you also find in that section, I've clipped as an insert the current policy and the draft of the policy. And by no intention am I going to run through this line by line. I want to highlight the key differences. And then towards the end of the meeting, really scope out the process moving forward to eventually move in that direction. But if you look on page 7 at that top bullet point there, that's really the main purpose of your policy statement. And I would argue that really it's a roadmap, right? Answering those key questions of who's responsible for what are we trying to do, and how are we trying to do it, right? And it should be really clear, concise, well-defined. And if you think about it, the example, if we had a new trustee come onto the board, we would hope that that document would give them a good foundation of answering those key questions. So that's the ultimate goal with that statement. And as you note there, it's highly customized. So when we look at the LoSAP and then later this morning at the OPEB, there are key differences just based on the unique characteristics, the size of the funds, the asset allocation, things like that. So I'll highlight those at our meeting later this morning. And then finally, you see in this last bullet point here what the IPS should cover. So we're big believers from a best policy perspective. And those sub-bullet points, these are the items that should be addressed. So, what do these entail? When you think about background and purpose, it's, mainly the county sponsors this plan, defines the beneficiaries, who meet the eligible benefits. And then the purpose is more of an executive summary of all that flows through the rest of the document, namely those bullet points you find below. So when you think about governance, it's defining, or governance is defining responsibilities. So trustees' responsibilities, us as the consultant, investment managers, custodians, everybody's playing a key role here. So let's clearly define what the expectations are from each of those respective parties. Standard of care, this is something that we didn't see in the current document, but we think is of utmost importance. This is things like prudence. Everybody, all trustees or everybody acting on behalf of the plan should be acting in the best interest of the participants and their beneficiaries. Discusses things like ethics and conflicts of interest. If there are any conflicts or even the appearance, it's best practice to have them disclosed so everybody is keenly aware of those. And then as you work your way down the page, a lot of these speak for themselves. So investment objectives, risk tolerance, asset allocation, we covered that at the last meeting. And then implementation. So if you think about asset allocation, that's really the what, right? What's to be included, but then implementation, how are we going to do it, right? So more clearly define the permissible and prohibited parts of each of these respective asset classes. And then finally, review procedures, right? It's best practice to review this document probably once every couple years, review performance, investment objectives, and vendors as well, like us, like the managers, like the custodians, not just when the RFPs come due, but take regular stock of how things are going on so we can have that communication and make sure we keep heading in the right direction. So with all that said, if you can grab those inserts on the next page on top is your current policy statement, and behind that is the draft. So with the current statement, I've highlighted a few key things throughout this deck where you'll find differences for our philosophy and what we propose. So you actually see on this cover page Down at the bottom towards the right, it lists the previous advisor. So we're a believer that obviously we facilitate, draft, and make revisions as the committee sees appropriate, but this is a county document. This is a committee document, right? So we'd be happy to list our name there and sign it in the back, but it's really industry standard that this is your document. The vendors are just a piece of the puzzle, but have nothing related to the actual policy itself. So similar in that vein, if you skip ahead to page 1, and you'll see the table of contents on page 2, but we'll hit on these as we walk through the deck. On page 1, you have an executive summary, right? And if you look at some of this information, some of it won't change, right? We know it's a defined benefit trust. We know the time horizon is long-term. So that would be tackled in, say, a background section. But some of this other information, you see current assets of $2 million. Well, we're well north of that now. We're going to be close to 10, it sounds like, in short order. So that's information that, in theory, you would have to revise over time, right? You don't want to be explicit about numbers like that because, again, they're not really policy and they change so frequently. So you don't want to have to revise the document. And then the expected rate of return, similarly, that's the assumed rate of return, which doesn't change that often, but we don't need to specify a number. We can just specify the assumed rate of return. So to the extent it goes up or goes down, that language saying that's the most important benchmark or bogey is relevant no matter what the actual number is. Mm-hmm. So on the next page, if you skip ahead, you see the purpose there. So largely in...
Yes, sir.
Expected
return. Now, isn't that predicated on an actuarial as to what this should return?
Yes.
Therefore, we use that as a basis or a benchmark for, so are you saying we wouldn't have a expected return, or we would look at it differently?
No, I'm sorry. I probably didn't outline that as clearly. So what we would say is that actuarial assumed rate of return is the bogey, but we wouldn't specify the number because that could change. So in the new document, it says, we are trying to meet or exceed the actuarial assumed rate of return, but we're not saying it's 6 or it's 6.5 or it's 7 because it changes over time.
Right. Well, I guess the reason you're sitting here is that we thought we had a poor return on our SORP. We thought it had a great return on our OPEB. LoSAP was too small to really make a difference in the program. But at the end of the day, we found that by doing that research that, now it's better. Let me just put it that way. Or we feel better about where we're going. Right. My thought, though, is that we need some kind of barometer to tell us, look, we're running ahead, we're running behind, and therefore we need to make adjustments, whatever they may be.
Right. So that would really fall under 2 umbrellas. Commissioner, this would be the one, because this is the most important bogey, right? As far as trying to improve the health of the fund. This is what the actuary is assuming, so we want to meet or exceed it. But then in relation to that, and we'll circle back to later, when we have that strategic asset allocation, whether it be equities, fixed income, or things like infrastructure or real estate that we talked about, then we clearly delineate the benchmarks for each of those respective asset classes. And then we use that as a weighted average to measure the success of them individually, and then the success of the trust relative to that. So that's really more...
Again, to me, it's about risk-benefit, analysis.
Sure.
All right, well, go ahead.
Okay. So if we skip ahead to page 3 here, again, the purpose, all this language is very relevant on page 2, and we've incorporated this in spirit in the new document. But if you look at the background here and look at that key information, right? So that's obviously relevant, right? What the fund is, who the trust sponsor is. So that's incorporated into the new document. But then below that, what I've highlighted, that's vendor information, right? It's not, we would argue, policy, right? And you wouldn't necessarily want to have to change the document if you changed vendors, right? So that's information that, again, we don't feel is necessarily relevant for a document like this. So not something we would typically include. If you skip ahead to page 4 and you look at the statement of objectives there, again, largely this is a section, and we'll see them many instances later on where it's still very relevant. The spirit of that text has been carried through to the draft. But if you look under time horizon, again on page 4, what I've highlighted there is around short-term liquidity requirements are expected to be non-existent. So that's very true. As a few years ago, it's true today, but it could change. right? So again, it's something that we wouldn't want to have to revise the document when that changes. So in the new document, as opposed to saying we don't expect any liquidity needs, we just say we consider liquidity requirements to the extent available that they'll be needed over time. Again, not really trying to constrain things, box them in. This is very important, we address it, but we're not defining whether we think we'll need it or not, because that could change.
Go ahead.
Okay. So on page 5 there, you see performance expectations, and this really circles back to some of the comments we made a second ago. And the highlights there, you see the desired investment objective return of 6.3. So to be honest, I'm not entirely sure where that number came from, because it's certainly not what the assumed rate of return, which is listed below that paragraph. And then again, below that, you see the trustees realize market participants that a 7.5% return may not be achievable. So there's a little bit of a disconnect there. So again, harkening back to my comments earlier, that most important bogey is the assumed rate of return. So when we think about performance, it's that number, and then it's the number relative to the benchmark. And then as you work your way down, you see asset allocation constraints. Largely, again, the spirit of that text and language has made it through to the new document. But on page 6, what I wanted to draw your attention to is the asset allocation. And this really gets back to those questions earlier. So we talked about who's responsible for what, and then what are we trying to do and how are we trying to do it. So in that table there, we would argue this is really the what are we trying to do, right? These are the specific asset classes, their targets and ranges, but there's not a lot of language in how we're trying to do it. And what I mean by that, the rows that I've highlighted here in real estate, emerging market equities, and high yield, they don't have specific guidelines within the statement. It's really just the equities, the fixed income, and the cash. So if we're going to incorporate these assets, we really need some guidelines around how they're going to be implemented to ensure that that's consistent over time with the existing policy. And I want to talk more about that in just a second to give you a clear illustration of what exactly that means given the current policy. If you keep working your way down, you see rebalancing, securities guidelines. Again, those that text and language largely has been carried through in spirit. But if you look at domestic equities at the bottom of page 7, this would be a key difference here in that first bullet point. So that language there is fairly standard, where it says, a manager can't hold more than 5% of a stock in their portfolio, but the market dynamics have changed so much over the past 10 years. So if we think about, say, a large cap growth manager in the US, where that benchmark is really comprised or really dominated by very large companies like an Apple, like a Microsoft, who might constitute about 10 or 9% of that index. So if you think about keeping this at 5%, you're really hamstringing a manager that you've hired to beat that benchmark, essentially saying, well, if that security is at 10% in the index, you can only hold half of it at most. So you're constraining essentially what you've hired them to do, essentially to beat that benchmark. So how we tweak it is what we say is a manager's able to hold the greater of 5% or 1.5 times the security in the benchmark. So if you have a benchmark that has a security of 8%, then they'd be able to hold essentially 12% or 1.5 times that. Again, trying to remove those constraints. If we're hiring a manager to do X, but then we're saying you can't do A by ABC, then it's much more difficult for them to really keep pace or try to meet or exceed that benchmark.
I think the thought process here is that you diversify enough that you kind of, balance your risk, and by keeping this number as how much can go in one direction. What are you seeing out there? Is this what people are doing? Is
Yeah.
go with the hot manager when that person's hot, or
No, that's generally a recipe for
Disaster.
disaster because things are cyclical. What we've seen here is this is very consistent with history, but as the market has changed, then a little bit more latitude needs to be given. But to your point, Commissioner, sure, you don't want to have, say, 20% of the fund in just one manager who could do all this. So then it's important to complement that manager like we've done over the past few months. So say in the U.S. equity space where you have your large cap growth manager, earlier this year we paired that with a value manager really to offset what they're doing in the growth space, again, trying to find more diversification, more balance, so it would mitigate that specific risk that you just mentioned.
But you're recommending that we loosen it.
Yes, sir. And
Enough
I'll
to-
point out that specific language in the next document.
All right, go ahead.
So if you skip ahead to page 8 here, and you look under domestic fixed income, this really circles back to the comments I made a second ago when you said, we have to define the how, or excuse me, the what, and then the how, right? So I had noted that a few of those asset classes didn't have guidelines. So technically, since high yield bonds don't have guidelines, they are fixed income investments. And if you look at that highlighted portion there, it says you can't have any fixed income investments that are lower than a triple B rating. Well, that's the last grade of investment grade. So you could technically read this document and say you're not allowed to hold any high yield bonds because they're within fixed income and they're all below investment grade, below that triple B. So again, it's important to give guidelines around each of those specific investments because again, you could argue that in theory you're in breach of that policy because you are holding those bonds and they're not defined elsewhere in the statement. So we'll do that in the new document as well. So if you skip ahead, there's not much else here. These, sort of guidelines for cash on page 9, the selection of money managers in 10, their duties on 11, all of this in spirit is carried through because this is best practice perspective. And if you work your way down from 12 and 13, it's very similar. Where we would argue a change needs to be made is really on 14. And what this is saying, essentially identifying the benchmark for the specific managers themselves. And again, we would argue that's not policy, that's implementation. So we define the benchmarks for those asset classes for that table, but then for the underlying managers that fall within those asset classes, they may have different benchmarks that are outlined here. So again, that's more implementation, not policy itself. So we would remove this page from the document. And again, where the benchmarks would be specified is at the asset class level alone, not the individual managers themselves, because that could certainly not be consistent with the benchmarks and the peer groups that were outlined here on page 14. For the rest of the document, again, as far as review procedures, manager selection, that will be carried along in spirit. On page 17, this is the final comment here. You can see this was really consistent with the earlier comments I made as far as it being a county document. Usually we would not sign this. Again, we facilitate, we develop, we take into account your suggestions and edited revisions, but again, industry practice isn't really for the advisor to sign it because it's a county document. So with all that said, any questions or comments about what I laid out before we shift gears and look at the current draft in its form right now?
Will there be a supplementary implementation document that will have the specifics?
No, because that's really found in the performance report. Because all of those specific managers, their benchmarks are laid out in the report. So within that tool, we can see whether or not they're meeting, exceeding, or perhaps falling behind what we've hired them to do. So that would fall under the performance report. That information would be there as opposed to trying to define the benchmarks here, which may not be consistent with the managers that are used in the trust itself.
And then are the benchmarks consistent? Do you change them?
They would only change if there was a new manager. So say, there was a hiring of an equity manager who was, say, more of a core, straight down the middle type of approach as opposed to, say, a value manager, then we wouldn't necessarily continue to use that value index for the new manager. We would use that different index. So again, that's a good example of how that's very fluid over time and would necessitate a change for the IPS if we continue using that table there. So it is captured in the performance report itself.
Okay.
Okay. So if we can shift gears, the next document behind that is our current draft, and we'll circle back to the end about the process of moving forward here. So you see the cover page there. If you look at page 2 with the table of contents and those bolded up sections there, that's basically the sections I had listed on the slide a few minutes ago as far as responsibilities, standard of care, objectives, risk tolerance, so on and so forth down the page. So each of those issues or key themes are addressed throughout the document. And to provide more color around that, if you look at the top of page 3, you could see the background. So here we're defining exactly what the plan and the fund is. So the county sponsoring this program, it covers these employees who meet the eligible requirements, and the trust itself is intended to meet those benefit promises over time. And I would note that we lifted this language from the trust agreement, so we would expect it to continue to be relevant, but to the extent that it needs to be tweaked, we probably would need some guidance from the committee or county staff about how to adjust that as appropriate. As you work your way down the page there, as I mentioned, as far as scope and purpose, that's really an executive summary of the document itself. Everything that's going to be talked about as it relates to responsibilities, standard of care, objectives, review procedures, things of that nature. So if you only had a couple of minutes really to digest this document, you would really want to read page 3 there as far as the background and the purpose, and the beginning of page 4, which really finishes up that executive summary of what the document is outlining itself. So on page 4, this gets into the governance section. You can see at the top line there the distinction of responsibilities, so clearly outline what are the responsibilities of the trustees. And again, this was largely sourced from the trust agreement coupled with your previous statement. Our responsibilities as the consultant, responsibilities of any investment managers there towards the bottom, and then at the middle or closer to the top at page 5, responsibilities of the custodian. So that's new language. Obviously, they are a very important party to this whole endeavor entrusted with the safekeeping and record keeping of the assets. So we do think it's best practice to include that language there, since again, they're a very important part of the equation. On page 5, again, here's the standard of care talking about prudence. Everybody should be acting in a prudent manner as it relates to the fund with the participants and their beneficiaries' best interests. The ethics and conflicts of interest, this is all around, what could constitute that and any required disclosure that a committee member or really any fiduciaries, ourselves included, would have to disclose to everybody else. Whether they exist or at least the appearance of them can exist, to help the committee take that into consideration around any future recommendations as appropriate. So on page 6, and circling back to your comment earlier, Commissioner, under investment objectives, you see the return objectives there, and then that first bullet point. So again, the primary objective, earning a total return net of fees that achieves at least that actuarial assumed rate of return, which is 6%. Again, we're not defining the 6 because it could change. And then below that, the return from all the investments is expected to meet or exceed that designated benchmark as well. So all the specific benchmark for the relevant asset classes over the long term, we would expect, again, to meet or exceed that on a net of fees basis. So defining those objectives still, but not incorporating the specificity, which could necessitate revisions over time more frequently than we would like to necessarily address. On the top of page 7, again, just a couple of quick changes. When you look at asset allocation, again, that language is largely in spirit with what you have now, but one key difference is we outline the asset allocation, the targets and the benchmarks more in an attachment, because what you'll find, which is at the back and I'll reference, as opposed to in the body of the text, because that is one of the items that changes more frequently than most. So as opposed to having to revise the body of the document itself, you can just swap out the attachment. I think it's more straightforward, simple type of exercise to the extent that those things are warranted. And then you can see in the middle of the page there, liquidity, again, not really specifying that we don't expect liquidity. We do expect liquidity, just saying that we are taking this into consideration, right? We're going to monitor liquidity over time as it changes, and liquidity will be addressed through investment objectives, asset allocation, and guidelines, things of that nature. So the committee is aware of it, cognizant of it, and we're taking that into consideration with the decisions that are being made over time. So continuing on here, a lot of the rest of the document, when you see the investment manager selection criteria at the bottom of 7, is largely consistent to the previous document. But where things change, if you look at page 8, are the investment guidelines. So again, this isn't just the what, but the how. So all of those asset classes that are permissible, making sure we're addressing all of them in this section. So you can see as you work your way down the page, you see equities. Obviously, they're a big part of the trust itself. But then as far as real estate and infrastructure, things that weren't previously addressed are addressed now to provide some guidelines. At the top of page 9, similarly for TIPS or Treasury inflation protected securities, again, putting the guidelines around those investments. And then importantly for fixed income, what we've done here, like I showed you previously, there was no allotment for below investment grade bonds. Here, what we've done is remove that constraint, so the guidelines are largely consistent with the previous fixed income, absent that one piece where we're saying we can't do this, technically, even though we're doing it. And where that constraint comes into place is later on, where you see the targets for each asset class and then the ranges. So high yield is constrained through that, because we say we have this target, but we can't go above that target plus X percentage points. So it's within the document, and having that asset class could still be very much permissible because we're not constraining it within fixed income and saying we can't do it at all or whatsoever. So with the rest of the document, again, pretty straightforward here. We have the prohibited investments under on page 9. Those are largely consistent with the previous document, which we saw as best practice. On page 10, the review procedures, the investment objectives as things change, the review of performance, which we do on a quarterly basis, so that'll be relatively easy and straightforward to tackle. And then at the bottom, other service providers, again, it's incredibly important for the trustees to continue to evaluate over time how things are going, how we're doing, how the managers are doing, which we will help with, how the custodian's doing, which we will help with. Really for that continuous, hopefully, improvement, right? As we continue to meet, we continue to get it on a good track for how these meetings should proceed. But over time, certain committee members or the committee in general might have different ideas. So we need to continue to have that consistent communication so it's an effective use of the committee's time meeting in and meeting out. So that's really of utmost importance. Generally a conversation we wouldn't be a part of, but we think the committee should certainly have from time to time, and then hopefully provide us and any other vendor that feedback about how to improve more moving forward. And then finally, you see on page 11, as far as the signature page, you see there'd be just a required signature from the county, or excuse me, the committee there. And then on page 12, to wrap up, it would be the asset allocation targets, their ranges, and their respective benchmarks. So if you look in the middle, the targets there, this was the previously approved targets per our last meeting. All the way on the left, there are the respective asset classes, and then we have the minimum and maximum ranges. So if it's a larger allocation like equities, it's generally plus or minus 10%. If it's smaller, like within equities on emerging markets or within real assets like REITs, infrastructure, TIPS, generally 0% to say 2 times that very small allocation. So when we think about the policy moving forward here, I think, and this is segueing into the next steps, which we'll get to in just a second, it would be our recommendation, obviously this is a lot of information and didn't want to walk through it line by line, but to the extent that the committee wanted to take time between the next meetings to review this in a more detailed fashion, we could revisit it at the next meeting and say, no, we think we should make an edit here, a revision here. We can incorporate it into the document at that time, and then a subsequent meeting, we'd essentially be ready to go for execution of the document and then implementation at that point to get things in line with the newly approved asset allocation.
Do you see any changes by implementing this document versus what we had before? Would you come along and say, by the way, because of our new policy, we're going to start doing things a little differently as far as these allocations?
So I think, yeah, that's a good question, Commissioner. A couple of different things. So number one, there are 2 new asset classes in here. If you look under the real assets, remember we talked about the importance of having those inflationary insurance buckets in the portfolio. So within REITs and infrastructure, REITs are already there, excuse me. It's really infrastructure and TIPS. Those would be new asset classes within the portfolio itself. And then to your other question, the trust was more of a 60-40 type of mix before. So very, very conservative, and rightfully so as you're sort of building up the trust, building up assets. There was a slight movement as the trust gained assets over the past few years to just become slightly more aggressive based on our conversation at the last meeting. So not 60-40, but just 65-35. So we would expect those long-term return expectations to tick up commensurate with
So
that
it wouldn't be any
increase in
big
equities.
jumps, but it could
No.
be some incremental
Incremental.
adjustments.
Correct, yes, sir. And again, like I talked about earlier, excuse me, the new allocations compared to the existing one, if you recall that fund allocations page, we're already about 2 to 3% overweight the 60% target. So to get to 65, we're only talking about another 2.5% additional
Right.
allocation.
It's not a big jump. I believe that, to be effective, we need to be flexible. And a lot of times, policy statements can take away flexibility.
They can, and I think that's why we try to address what we believe needs to be addressed, but kind of loosen the constraints so that they're there, but we're not hamstringing or tying our hands from time to time. And again, this is something we revisit every year as far as the asset allocation study.
And let me just tell you, it all works fine as long as things are going up.
Yeah, you're right. It does, and things have worked pretty well so far this year. But to the extent that, and it's a little bit more difficult for the LoSAP given the low asset base, and that's why we want to stay passive, keep low costs down, and compound. I'm not telling you anything you don't already know. But as the trust grows, there could be an opportunity maybe to introduce a new asset class or perhaps introduce active management in certain areas, but we'll make those recommendations as the trust continues to grow and as conditions change as they always do. So with that, I'm sorry, Ms.
Just a
Pratt.
couple quick questions.
Yes.
So on page 10, under review of investment consultant and other service providers, are investment managers included there?
Well, that would really be our function, as right. So, and that language is under our responsibilities earlier on. So those review procedures. This is more on sort of say an annual basis from the committee perspective. But if you look into review of investment performance, Ms. Pratt, and you see the investment consultant will report on a quarterly basis to review the performance of the trust, which would be inclusive of strategies and investment managers as it relates to the bottom of that paragraph right there.
So if somebody was on a watch list, for example, or you were concerned that is going to be something you provide and it falls under your requirements?
Yes, that's
Okay.
correct.
Okay.
And those are all defined on page, gosh, I don't see a page number,
Yeah.
4,
Yep. I'd just
as
like,
far as
yeah.
responsibilities. Thank you.
Right, thank you.
And then on the attachment,
Yes.
where you have the, is it international, developed, and emerging markets? What do you mean when you say net over in the benchmark?
Okay. So the international equities have reciprocal tax, and I'm going to get the nomenclature wrong. I'm looking at Jeanette. She probably knows better than me, but reciprocal tax agreements, meaning that certain investments made overseas, they don't come under a double taxation, essentially. So if you're taxed at the international level, us as U.S.-based investors can file documents to essentially recoup those taxes. So if they're taxed internationally, when the funds come back, they're not taxed domestically. So that net, what that means, it just takes into account those tax dynamics because it's not relevant for the domestic investments. Like the U.S. equity Russell 3000, it's irrelevant because they're just taxed once, and then so on and so forth down the page. That's not really a consideration. So the benchmark there takes into account that additional layer of tax complexity for U.S.-based investors. So say for like, say, an international-based investor, they would show, say, the Russell 3000 net, and then some of these other benchmarks wouldn't show net.
Okay. One more question about proxies. So who votes proxies?
So this is found, and I apologize for glossing over this, on page 7 in the middle of the page. So proxies, based on the LOSAP structure where you just have mutual funds or ETFs, who votes those proxies are the managers themselves,
Okay.
because there's all underlying investors. That would only come into play if there was, say, a separate account manager where they're managing money at the custodian bank. Then they have the proxies, and then the county or the committee can give them the authority to vote on them or have some sort of proxy guideline in place. Normally, industry standard is it's outsourced to those managers because they, are boots on the ground. They know the corporate proxies. So it's not relevant at this time unless there was, say, a separate account, fixed income or equity manager over time, and then that would come into play. I think this is more just, hey, the board or the committee recognizes that proxy voting is very important. So to have that language within the document itself is more of a best practice
Okay.
approach.
Thank you.
Okay.
We're all about best practices.
So with all that said, if it would please the committee, we can wrap up here behind Exhibit 3 on the next
Certainly.
document, and we'll talk a little bit about how to proceed moving forward here. So at our next meeting in August 25th or 26th, I believe, we'll have the Q2 investment performance report at that time. We will have any recommendations as appropriate, like we did today, to revisit that. And then what I think might be most prudent, again, is to revisit this policy. So obviously, you all are seeing this for the first time today. Be prudent for trustees to maybe review it before the next meeting, and when we meet again, maybe
I think it's the 27th.
propose any suggested changes or revisions for us then to go back and incorporate them into the document. And once that's done, we can come back and essentially be in a place where the document can be executed. And at that time, the implementation would occur concurrent to that to move to the new targets. And then from a subsequent meeting perspective, again, we'll continue on the reporting, the recommendations, the policy to the extent that we need to continue work on that to get it moved forward. And then finally, around any continued custody updates and then the traditional versus OCIO discussion to the extent the committee wanted to continue to explore that. So again, I think for our August meeting, if the committee has time to review the draft and come back with any, potential suggested changes and revision that would continue us on this path of progress to ultimately getting to where we need to be.
And our next meeting is August 27th.
Thank you.
So that wraps up my comments for this morning. Again, I'm happy to answer any questions or comments the committee has at this time.
I don't have any.
Yeah, I don't have any. Thank you very much.
Keep making money.
Yeah.
That's the only comment I got for you.
So next, we would move into old business with Ms. Pratson discussing the LoSAP benefits, legal and financial cost analysis.
Thank you. You may remember at the last meeting, we discussed the request submitted by the Emergency Services Board that had to do with modifying 2021 point awards based on the pandemic. And then in addition to that, there was a request for increased benefits in 2022. We took a look at what other counties are offering for benefits. And then we also reached out to Bolton and Mary Claire for estimates if they were to provide an analysis. So if you would take a look, please, at the cover memo, the proposed benefit changes are summarized in a table. So currently, we offer benefits for members that are aged 55 and have served 20 years or more. One of the proposals is to offer a benefit to people aged 46 and over, and they would have served 30 years is the proposal. And then you'll see we offer a benefit for those who are 60 and have served 20, and then who are 70 and have served 3 of the last 5 years. And then the current benefits that we offer are listed on the table, and the proposals are listed also. So a significant increase in the benefits is being proposed.
You know, I saw that letter from, I guess it was Sean Davidson, talking about giving a property tax benefit. We don't do that now.
Not that I'm aware of.
When I was at Mako it wasn't last year, a couple of years ago, sometime recently, I saw Queen Anne, because I see Queen Anne on here. What they do, they give their people $1,500 credit on their property taxes for meeting their points. And it would be interesting to know what the impact of that would be. But what the key was, is they talked about a couple who had a couple of children, and, you know, everybody's busy, everybody's working, but the wife apparently was her turn, let's say, and said, hey, look, I'm going to do this. I'm going to be gone for 8 hours. You get the kids, dinner's in the microwave, whatever. And the point is that I'm doing this because I get $1,500 off my property taxes a year. And it seemed to be something that helped them. Now, was it all of it? No. But those 4 recommendations, I mean, giving them free access to the landfill or the convenience center, you know, that seems to be pretty, can we do things other than, or can we figure out if we do those 4 things that he's requested there, it doesn't look like there would be a big impact other than the property tax.
I think access to the health insurance plan would be a big impact.
That would be a big impact.
And one of the concerns that Mary Claire has, that she would, you know, if we authorized her research, is at what point are you treating a
Making them
volunteer
county employees.
as not a volunteer?
All right, that's a good
It's
point.
a really gray line.
And then if someone can argue that you're being treated as an employee, that extends to workers' comp, that extends to
Look, I
liability.
get it. I guess my point is that typically when we control when they come to work and when they go home or that type of thing, they can be considered employees, but volunteers,
Right.
by just the word states that they can come and go as they want, I would assume.
And volunteer whenever they want. We have no control over when
Yeah.
they show up and not.
Right.
She also said that it could implicate the tax status of the plan, because it's a plan for volunteers. So we would have to tread very carefully.
Well, I guess I could see the health part not being part of it.
Right.
And probably the gift card thing, I'm not sure, that seems to be a little, well, whatever.
Right.
But I could see, you know, free access to the landfill if you,
And property tax, we
and
certainly.
some type of
Well,
property.
we did that for the last, not this past budget season, but for the last, we did a study about the affordability and providing a property tax credit to the fire and rescue community, and it did not get approved by the commissioners
What was the
for
problem with that?
affordability. It was just too expensive to provide, because it was to the
But weren't we
public.
giving them like 100% or 2,500 or something like that?
No, I mean, not at this time, no, but I
No,
mean,
no, when we,
I'll have to go back
I
and
got a
find
good
that
memory,
from the
but
last
some days
couple
I
of
do
years.
forget.
But it was for all public safety. It was for
Right.
the sworn.
yeah,
It was the fire and the
yeah.
rescue
I
and,
remember now.
yeah, and I can go back and pull it, but I mean, it was, the affordability was
Well, I
just
think the key
more than
though,
we could handle,
that was with paid employees,
right,
which, okay, ended up being another benefit.
right.
And I think that was the sticky wicket.
But it also
some of us.
include the LoSAP, people too, the volunteers.
So maybe we could carve out, maybe we'll just pull out the
We'll
study
pull
and
that
see.
out and
Yeah.
see where we ended up and what.
But let's focus it on the volunteers.
Right,
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 Right.
right, cut out the paid part and see.
right,
Right, and
See
just
if we
do the
can figure out.
volunteers.
right, and see what it looks like.
Yeah, we'll pull that out.
And another, and if you took a minute to look at the chart, this is an updated chart of what other counties offer in terms of benefits.
Right.
We currently offer a $2,500 insurance policy for a burial benefit only in line of duty. That could be something that we could look at. It looks like many other counties have a burial
They have a
benefit,
higher one.
and they also don't have that restriction.
So for line of duty, it's
Right.
just,
Right, so that could be something. We're the only county that has in the code that we will increase the benefit for cost of living.
Yeah.
Nobody else commits to that, other than St. Mary's County. So that chart that reflects the $200 payment monthly and the $150 payment,
Right.
that's upon entry. Every year, that gets adjusted for cost of living.
Yeah.
Tell me though, I still believe that COVID, I was in the barber shop yesterday and speaking to the experts on EMS and fire, the Gattons. Anyway, the point is that their belief is that a lot of these people are not coming back. That this pool that's actually available to LoSAP or, working towards, that pool may diminish. What's your thoughts on that?
We haven't seen that in the eligibility list yet.
So it'd take probably a couple of years for that
Right.
to figure out.
I mean, they had as many members eligible for calendar year 2020 as in 19.
But we did make adjustments to allow them to get the
Extra
points.
points.
And so when that goes away, which I'm thinking it goes away,
Well, they're asking for 2021 adjustment too.
okay, I hear that. But
Right.
what did we ever decide about, or did we make a decision about auditing because I remember I was talking to Paula Turner, I think's her last name, and I asked, well, do we do audits as to, are the people actually showing up and doing what we expect them to do, or
The county does not. County does not, and part of the code is
would
saying.
would that be like a slap in the face to ask someone to do that?
I would think that would be controversial.
It would be.
I mean, it's kind of like, look, if somebody's gaming us, we need to figure it out. I mean,
Well, and it's interesting, and so the code states that it's the rescue squad, they are
Yeah,
certifying
yeah,
those lists, and the county is relying upon their certification.
okay, I guess we wouldn't want to throw any shade on them, but
We would want to tread carefully.
yeah, that's a better term. All right, go ahead.
So I would ask, is the committee interested? Should we have Bolton conduct an analysis of the cost to the plan if we were to increase the benefits as requested? And then, and/or should we have Mary Claire conduct an analysis if we were to consider the health insurance?
Well, I think if we're talking $2,500, I can go there. If we're talking $25,000, which is a typical Bolton,
They said 2,500, and Mary Claire, I think that might be a typo. I think Mary Claire's is 2,700, I'm sorry.
okay. Well, again, I want to make sure that what we're paying for.
Right.
I would be fine with the Bolton one, because that's going to go to whether or not we could increase the monthly benefit, right, by the proposed rates. And looking at your comparable Maryland County chart, we seem to be we do pretty well compared to other counties. So, half the counties appear to have maximum benefits. We don't have that. But for Mary Claire Cheshire to review regarding the health insurance plan, that just seems to me to be a non-starter, so I don't see the need to do that.
No, I don't either.
Yeah, I agree.
And again, if Bolton will do it for 25, that doesn't seem.
They
100.
would, yep, they will,
Right.
they would look at their request for the increased benefit and what the cost is to the plan.
Okay.
And I think one of the things that maybe would come out of this, whether we make changes or not, is we need to communicate with the volunteers that additional $3 million commitment and what that means to them.
Yes. Well, now
Because I don't know how well that's understood.
well, I agree.
Right.
Now, part that's kind of continues to be not misunderstood, but hard to understand is the number that we're reaching for. I've always heard this number 17 million.
Right.
And is that still the true number?
It's still in that 17 area
Because just to interject
as far as the liability.
Pat into this conversation a little bit, is this is all predicated on getting to an amount that we do not have to go out of general fund.
Right.
That these funds get to a point where they can be self-sustaining.
Right,
And it seems like OPEB's getting there.
right.
But I don't want to fool with that quite yet. But we do need to, in county government, we do need to have relief valves, okay, in case we can't do something for some reason, that we can tap into these. So if I remember right, Bolton said if we can get to 80% is where we should figure that
Right.
as a goal before
gave
we
us a
start
chart.
taking some kind of a
Right.
ARC out of it. And so I just want to make sure I understand what that number is too.
Right.
Here, is it 17 and 80% of that, or is it, because it seemed like the other one went from 106 to 122 if we're going to start taking out the ARC and,
Right. Well, I think, yeah, the OPEB is now at 80% funding, the policy is. And they gave us a chart that showed how much
Well, it's
we
over
should be
80%,
contributing.
right?
Right, we are over 80%. We were 93% with the
Yeah.
2020 audit. So we'll continue to monitor that.
well,
and
again,
then-
it's a, for commissioners, at least for this commissioner, it's a potential, not coffee can, that's my term from way back when. But I still say it's a potential revenue source to offset some kind of a drop in revenues that interferes with our ability to provide services.
In the future, right?
Yes, because it
Right.
gets away from general fund
Funding, right,
and gets into
Right.
funding through the
funding it through the trust.
trust.
And for a volunteer, that continued funding of the plan is a commitment on the county to their future.
Right,
And so I think that, property tax and landfill and all that are gravy compared to the commitment to the plan.
Yeah.
And I don't know how accurately or well that's being communicated.
right.
So, again, the result of all of this is we might want to end up with some kind of memo, some kind of
Well,
something.
You know how we do a benefit statement for the employees?
Mm-hmm.
Maybe we could kind of do something like that for
For the LoSAP?
the LoSAP people.
I think it would be good for them. I know my wife, she goes down to this, not that we're really worried about LoSAP at all, but the key gets, and she'll never put enough time in to qualify. But the point is, she comes home from like 8 hours of that stuff.
Sure.
And I'm like, God, what was it?
Right.
And she's like, it was exhausting, but I got 6 points. I'm like, well, thank God, but what's that mean?
Thank you for your service.
Yeah.
Yeah. I mean,
And potentially, as you said, potentially a property tax credit would be more relevant.
Right.
People would, it would connect the dots a little better.
Right,
Yeah.
yeah, that's
interesting.
that's where I would go for it.
Yeah.
Someone can actually see
Right,
this is a return. Because when you got to do 20 years or 30 years or whatever
Right.
to start getting your points or start getting some kind of return, my wife's 60, I'm 60, she's 67. She ain't gonna be hanging around long enough to do that. She just wants something to do.
right, right.
But it's turned into like a job,
Right,
You show up, geez, you're
Competitive.
eight hours, Anyway,
So if the board would make a motion, if you would consider hiring Bolton to do the analysis, And then perhaps we can come back, Jeanette, with the
All right, I'll second that
Property
motion.
tax, yes,
assessment as well.
yes.
I'll second that motion.
Okay, we have a first and a second. All in favor?
Aye.
Ayes have it, motion carries.
Thank you.
Catherine, you made the motion, by the way.
Yes, she did.
Thank you. And then, yeah, Jeanette, if you wouldn't mind
I'll
unearthing
pull that study
that
and
study,
we
Right.
can dust it off and update it.
and
Sure.
see if we can carve out, you know, what the
Yeah.
volunteer
Yeah, I
cost
think
would
that's a
be.
good idea.
Yeah, because I can't
Certainly.
imagine the landfill part of it's gonna amount to a
No,
lot.
Okay.
and more of a courtesy.
Yeah, absolutely.
And that would take us to the end of the meeting. If anybody has a
We may
motion,
have-
or do you have something else?
We don't, I didn't know
Yep.
if we had an administrator report.
No, we do not, so
No, we'll have that for the August meeting.
I'm looking for a motion to adjourn.
So moved.
Second.
All in favor?
Aye.
Aye, ayes have it, motion carries. Meeting adjourned.